What if I told you that the world's most successful investors follow a simple 3-number code that could completely transform your financial future? Before you click away thinking this is just another get-rich-quick scheme, let me share something that might shock you. The average person spends 40 years working and retires with less than $50,000 in savings. But there's a small group of people who've cracked a code that allows them to build extraordinary wealth using just 3 numbers: 6, 5, and 2. And by the end of this video, you'll understand exactly how this secret formula works and why it's been hiding in plain sight this entire time. I'm about to reveal a wealth-building strategy that combines the wisdom of legendary investors with a mathematical approach that's so simple, yet so powerful, that once you understand it, you'll wonder why nobody ever taught you this before. This isn't about picking stocks or timing the market. This is about understanding how money really works and using that knowledge to your advantage. The 6-5-2 strategy isn't something I invented. It's a pattern I discovered after studying the portfolios and investment philosophies of billionaires, hedge fund managers, and financial institutions that consistently outperform the market year after year. What I found was that despite their different approaches and varying investment styles, they all followed remarkably similar principles that can be distilled down to these 3 critical numbers. Let me start with the number 6, because this is where most people completely miss the point about building wealth. The 6 represents the 6 different asset classes that truly wealthy people diversify across. Now, when most people hear diversification, they think it means buying different stocks or maybe splitting money between stocks and bonds. But that's amateur hour thinking, and it's exactly why most people stay broke. The wealthy understand that real diversification means spreading investments across 6 distinct categories that respond differently to economic conditions. These categories are equities, which include stocks and equity funds; fixed income, which covers bonds and debt instruments; real estate, both direct property ownership and real estate investment trusts; commodities, including precious metals, oil, and agricultural products; alternative investments such as private equity, hedge funds, and venture capital; and finally, cash and cash equivalents, which provide liquidity and opportunity. The genius of this approach is that when one asset class is struggling, others are typically performing well. During inflationary periods, commodities and real estate often thrive while bonds suffer. During market crashes, cash becomes king while equities plummet. During economic growth, equities soar while commodities might stagnate. By having exposure to all 6 categories, you're positioned to benefit regardless of what's happening in the economy. But here's where it gets interesting. The wealthy don't just randomly allocate money across these 6 categories. They follow specific allocation principles that most financial advisors won't tell you about because it would put them out of business. They understand that the percentage you allocate to each category should be based on your age, risk tolerance, and most importantly, your wealth accumulation phase. Now let's talk about the number 5, which represents the 5-year investment horizon that separates successful investors from everyone else. This is perhaps the most misunderstood concept in all of investing, and it's why so many people lose money in the markets. The average investor has the attention span of a goldfish when it comes to their investments. They buy stocks and expect them to go up immediately. When they don't, they panic and sell. They chase hot trends and abandon strategies the moment they hit a rough patch. This emotional roller coaster is exactly what keeps them poor. But wealthy investors think in 5-year cycles. They understand that markets are cyclical and that every investment strategy will have periods of underperformance. The key is having the patience and discipline to stick with proven strategies long enough for them to work. This 5-year principle applies to everything. When they buy real estate, they're not looking to flip it next month. They're thinking about where property values will be in 5 years. When they invest in a business, they're not expecting immediate returns. They're considering the long-term growth potential and how the business will evolve over half a decade. The 5-year mindset also helps them avoid the biggest wealth destroyer of all, emotional decision-making. When you have a 5-year time horizon, short-term market volatility becomes irrelevant. You're not checking your portfolio every day and making impulsive decisions based on daily fluctuations. You're focused on the bigger picture and the long-term trends that really matter. But there's another layer to the 5-year principle that most people miss. Wealthy investors don't just think in 5-year periods, they also rebalance their portfolios every 5 years based on changing economic conditions and life circumstances. They understand that what worked 5 years ago might not work for the next 5 years, so they adapt their strategies accordingly. This brings us to the final number in our formula, 2. And this might be the most important number of all because it represents the 2% rule that governs how wealthy people manage risk and protect their capital. The 2% rule states that you should never risk more than 2% of your total investment capital on any single investment or trade. This rule alone has saved more fortunes than any other investment principle in history. It's the difference between building lasting wealth and losing everything on a bad bet. Most people completely ignore this principle. They put huge chunks of their money into single stocks, cryptocurrency, or business ventures without understanding the catastrophic risk they're taking. They think they're being aggressive and entrepreneurial, but they're actually being reckless and foolish. Wealthy investors understand that preservation of capital is more important than generation of capital. They know that if you lose 50% of your money, you need to make 100% just to get back to even. But if you follow the 2% rule, even a string of bad investments can't wipe you out completely. The 2% rule also forces you to diversify naturally. If you can only put 2% of your money into any single investment, you'll need at least 50 different investments to deploy all your capital. This automatic diversification protects you from concentration risk and ensures that no single mistake can derail your financial future. But here's where the 2% rule gets really interesting. It doesn't just apply to individual investments. Smart money managers also apply it to investment strategies and asset classes. They won't put more than 2% of their capital into any experimental or high-risk strategy, no matter how promising it looks. Now that you understand the individual components, let me show you how the 6-5-2 strategy works in practice. Imagine you have $100,000 to invest. Using the 6-5-2 approach, you would first divide your money across the 6 asset classes based on your age and risk tolerance. A typical allocation might look like this: 30% in equities for growth potential, 20% in fixed income for stability, 15% in real estate for inflation protection, 10% in commodities for diversification, 15% in alternative investments for enhanced returns, and 10% in cash for liquidity and opportunities. Within each asset class, you would follow the 2% rule, never putting more than $2,000 into any single investment. This means you'd need multiple investments within each category to fully deploy your capital safely. And you'd commit to holding this allocation for 5 years, rebalancing annually to maintain your target percentages, but not making major strategic changes based on short-term market movements or economic headlines. The beauty of this system is that it removes emotion from investing while ensuring you're positioned to benefit from whatever the markets throw at you. During bull markets, your equity and alternative investments drive returns. During bear markets, your bonds and cash provide stability. During inflationary periods, your real estate and commodities protect your purchasing power. But the 6-5-2 strategy isn't just about asset allocation. It's about developing the mindset and discipline that separates wealthy investors from everyone else. It's about thinking long-term instead of chasing short-term gains. It's about managing risk instead of swinging for the fences. It's about being systematic instead of emotional. The wealthy understand something that most people don't. Investing isn't about being right all the time. It's about being right often enough and managing your mistakes well enough that your wins significantly outweigh your losses over time. The 6-5-2 strategy ensures that you'll be right often enough by diversifying across multiple asset classes, and it protects you from catastrophic losses by limiting your exposure to any single investment. This approach also scales beautifully. Whether you have $10,000 or $10 million, the principles remain the same. The percentages stay consistent, and the discipline required is identical. This is why you see the same investment approaches being used by both millionaires and billionaires. One of the most powerful aspects of the 6-5-2 strategy is how it compounds over time. Because you're consistently reinvesting returns across multiple asset classes and maintaining proper diversification, your wealth grows exponentially rather than linearly. Small gains across 6 different categories add up to substantial returns over 5-year periods. The mathematics of compounding become even more powerful when combined with proper risk management. By following the 2% rule, you ensure that you stay in the game long enough for compounding to work its magic. Too many investors blow themselves up early in their careers and never get to experience the incredible wealth-building power of long-term compounding. Another crucial element that makes this strategy so effective is how it forces you to be a contrarian investor. When one asset class is performing poorly and everyone is avoiding it, the rebalancing process forces you to buy more of it. When an asset class is hot and everyone is piling in, you're naturally selling some of your holdings to maintain your target allocation. This systematic approach to buying low and selling high is how the wealthy consistently outperform emotional investors. The 6-5-2 strategy also provides incredible peace of mind. Because you're diversified across multiple asset classes and not risking more than 2% on any single investment, you can sleep well at night knowing that your financial future isn't dependent on the performance of any single stock, sector, or market. This peace of mind is actually a competitive advantage. While other investors are losing sleep over their concentrated positions and making poor decisions based on fear and greed, you're calmly sticking to your systematic approach and letting time and diversification work in your favor. The strategy also helps you avoid the biggest mistakes that destroy wealth. You won't chase hot stocks because you're committed to broad diversification. You won't panic sell during market crashes because you have a 5-year time horizon. You won't risk your entire portfolio on a single bet because of the 2% rule. As we wrap up, I want to emphasize that the 6-5-2 strategy isn't a get-rich-quick scheme. It's a get-rich-certain scheme. It won't make you wealthy overnight, but it will make you wealthy over time if you have the discipline to stick with it. The wealthy understand that building real wealth is a marathon, not a sprint. They're not trying to hit home runs with every investment. They're trying to consistently get on base and let the mathematics of compounding and diversification do the heavy lifting. If you're serious about building wealth, start implementing the 6-5-2 strategy today. Begin by educating yourself about the 6 asset classes and how to access them. Develop the 5-year mindset by setting long-term goals and ignoring short-term noise. And most importantly, never risk more than 2% of your capital on any single investment. Remember, the wealthy aren't smarter than you. They just follow better systems. The 6-5-2 strategy is one of those systems, and now you have access to it. The question is, will you have the discipline to use it? Your financial future depends on your answer to that question.